Good evening. Please come to IAS 10. IAS 10 is event after the reporting period. This is a very simple standard. It deals with what about the events and transactions which take place after the end of the reporting period and before the financial statements are authorized for issue. Okay. We have not yet issued the financial statement, but some transaction might take place. Question is, what will you do with respect to such transactions? So let us assume our reporting date is 31st March 2020 and the date of authorization by board of directors is suppose 30th June 2020. That is, board of directors have authorized that this financial statement can now be issued to the public, to the stakeholders, to the shareholders. And during this period, certain events, transactions takes place. Are we required to adjust the financial statement as on 31st March 2020? Are we going to change the carrying amount of asset, liability, income, expense on 31st March 2020? That means, are we going to make adjustment in carrying amount of asset, liability, income and expense, or just disclose, or third, do nothing? That is also possible. I may make a normal sale of inventory during this period. Do I need to make adjustment? Do I need to disclose, or just do nothing? Is it right? An employee was hired in this period. Do I need to make adjustment or disclose? No. But suppose there is a fire in the factory, there is a business combination, there is an acquisition of a subsidiary, disposal of subsidiary, court case settled, wage negotiation with the employee, a debtor becoming bad, fraud, etc. taking place, issue of share, buyback of share, right? These events have taken place, and these events are now significant material that it might influence the decision of the users of financial statement if he knows about such information. For example, if the company have issued convertible debentures, huge number, which means in future the stake will get diluted. So therefore, those who will get this financial statement should know that this event has taken place. So the SOFP which I see now will not be the same in the coming year. So therefore, the standard says either these adjustments which are significant will be adjusted, information will be adjusted. If not adjusted but significant, will at least be disclosed, so that the users of the financial statement can take a more informed decision. Okay. So we are informing them well in advance by disclosure. Otherwise, he will get to know about these events after some period, but then it will be too late for him to take any proper decision. The standard provide guidance determining the period up to which such event should be considered. So what is the period up to which such event will be considered? Up to the date of authorization of issue of financial statement, not the AGM date. Okay, so that we'll discuss in detail. When an entity, second thing this standard discuss, when will you adjust the financial statement? And third is when you will not adjust but only disclose. If it doesn't fit into either of these two, it means do nothing. Is it right? So many events and transactions will take place between your reporting date and the date of authorization of issue. Does it mean that I need to keep disclosing each of them? The answer is no. So now we'll come to the definition of events after the reporting period. Event after the reporting periods are those events. It can be favorable or unfavorable. There is one question at the end of this chapter that there is a favorable event. Company has won the court case which was going since last 1 year. Management says there is no need to disclose this. It's a favorable event. So you have to say the definition of event after the reporting period says those events which are favorable or unfavorable. What is unfavorable event? Loss in a court case, fire in the factory. Is it right? So that is unfavorable. Wage negotiation with the worker where you had to pay them additional compensation. Then your value of your machinery may have gone down. Value of your investment may have gone down. Value of your inventory may have gone down drastically due to a change in the government policy or competition or technology, etc. These are unfavorable. That occur between the end of the reporting period, in our example 31st March 2020, and the date when financial statements are authorized for issue. So in our example 30th June 2020, between this date, if any favorable event or unfavorable event takes place, then they are called event after the reporting period. Now first we will learn process involved in authorizing the financial statement, and then which date will be relevant, the cutoff date. Cutoff date is important in this chapter because some questions will be based on cutoff date. Auditors have completed their work on 31st May, but board meeting concluded on 30th June. Annual report was dispatched on 15th July. AGM took place on 31st July. So which will be the cutoff date? So that we'll discuss right now. First we'll discuss and then you will get few questions on that. The process involved in authorizing the financial statement for issue will vary depending upon the management structure, statutory requirements, and procedures followed in preparing and finalizing the financial statement. So it depends on the management structure. If it is a corporate structure, then board of directors would normally authorize the issue. But if it is a partnership, partners will authorize. Then statutory requirement and procedures to be followed in preparing and presentation of financial statement. In some cases, an entity is required to submit its financial statement to the shareholders for approval after the financial statement have been issued. We have issued the financial statement to the shareholders, and then the shareholders in their annual general meeting, they approve the financial statement. The problem will arise, which will be the cutoff date to be taken here? The date when it was authorized for issue or the date when it was approved by the shareholder? So the answer is in the next paragraph. In such cases, the financial statements are authorized for issue on the date of issue. Underline, financial statement will be treated as authorized for issue on the date of issue, not the date when shareholders approve the financial statement. So as per this IAS 10, the date of authorization will be treated as date of issue, and that will be the cutoff date. So up to that date, any event take place, if it is significant, material, whether favorable or unfavorable, will get caught under this standard, and then we'll see the further treatment of that. There is one small example given. Date of board authorization for issue. many dates are mentioned here, and this can be an MCQ question, it can be a 2-mark question in the exam. Management of the entity completes draft financial statement for the year to 31st December 20x1 on 20th February 20x2. Draft financial statement was prepared by management. On 18th March 20x2, Board of Directors reviews the financial statement and authorizes them for issue. Entity announces its profit and selected other financial information on 19th March. So on 19th March, the information was made public. We have made so much profit in this year. Financial statements are made available to shareholders and others on 1st April 20x2. Shareholders approve the financial statement in AGM on 15th May 20x2. Okay. And approved financial statement are then filed with regulatory body on 17 May 20x2. So they have mentioned all process that they have followed, right from finalization of financial statement, approval by the board, announcement of the result, dispatch of annual report, approval in AGM, and then filing of the document with the registrar or regulatory body. Which date will be treated as date of authorization of issue for the purpose of this standard? So the answer will be 18th March. Financial statements are authorized for issue on 18th March. That is the date of board authorization for the issue. So what period will be called event after the reporting period? From 1st January to 18th March will be treated as event after the reporting period. Next paragraph just below that. In some cases, management of an entity is required to issue its financial statement to a supervisory board. Management is required to issue its financial statement to a supervisory board made up solely of non-executives for approval. In such case, underline, the financial statements are authorized for issue when the management authorizes them for issue to the supervisory board. Who authorizes them to issue? Management, not the supervisory board. Financial statements are authorized for issue. This is the date I have to find out. When the management authorizes them for issue to the supervisory board, and then supervisory board will take a decision, discuss. Okay, so there is a question on that. Example, on 18th March 20x2, management of the entity authorizes financial statement for issue to its supervisory board. The supervisory board is made up solely of non-executive and may include representative of employees and other outside interest. Now they have given a lot of details. Supervisory board approves the financial statement on 26th March. Financial statements are made available to shareholders and others on 1st April. Shareholders approve the financial statement on 15th May. Financial statements are filed with regulatory body on 17th May. The question they will ask you, what is the date of authorization of issue for IAS 8 purpose? So some student will write 18th March, some will write 26th March. What does the standard says? The standard says the date when the management of the entity authorizes financial statement for issue to the supervisory board is the cutoff date. So 18th March. Next paragraph. Event after the reporting period includes all events. Event after the reporting period includes all events up to the date when financial statements are authorized for issue. So if it is issued by the board of directors, then the date of authorization of board. But if it is issued to one supervisory body, then the date when management authorizes to issue to supervisory body will be taken. When the financial statements are authorized for issue, even if those events occur after the public announcement of profit or of other selected financial information. Now sometimes what may happen, that question will come in a proper format later. Our reporting period ends on 31st March 2020. Is it right? This is the reporting period date. First quarter ends on 30th June 2020. Then if it's a listed company, it will announce its quarterly results. It will announce its quarterly results, yes or no? Now in that quarterly result, they will also give you comparative of previous year. Comparative of 31st March also they give as far as statement of financial position is considered. You will study that in the interim financial report. Now that announcement of interim results supposed took place on 5th of July. Interim results were announced on 5th of July. The date of authorization of financial statement for year ended 31st March 2020 took place on 20th July. Now in this problem what has happened? The interim period results were declared before the date of authorization. So will you take this date or this date? Same, 20th July only. Sure. Yes. That may be a very rare possibility in a listed company. No, but it is possible. No? Rare is there in the exam. What is rare is usually there in the paper. So after the cutoff date understanding, now we will see what about the events which take place after the reporting period. So we will divide these events into two categories: adjusting event, non-adjusting event. And then you will get question on this two paragraphs. Most of the question will be around these two only. They will give you a case study and then you have to answer whether it is an adjusting event or a non-adjusting event. How to identify an adjusting event? How to identify whether an event is an adjusting event or not? So the standard says those that provide evidence of condition. Those that provide evidence of condition. That means the condition should be already in existence on the reporting date. Those that provide evidence of condition that existed at the end of the reporting period. What event after the reporting period is doing? It is only giving you more information about that condition which was already in existence. No new condition has arisen. Example, a court case. A court case was going on the reporting date. Results of court case, whether it is favorable or unfavorable, will become an adjusting event. Is it right? Then wage negotiation with the worker was in progress on the reporting date. After the reporting date, but before the financial statement were authorized for issue, negotiations were concluded and you will have to pay them additional wages. Adjusting event, because the negotiation was in progress. Government was in the process of bringing a law where the company will be required to pay if they have caused pollution. Polluters will pay. This company had been causing pollution, and now during this period, after the reporting date and before the financial statement were authorized for issue, the law has become an act. Okay, Parliament has approved, President has put his signature. Okay, will you make a adjustment for that, provision for that? Yes. So these are adjusting event. What about non-adjusting event? Non-adjusting event, those are indicative of condition that arose after the reporting period. You have invested in shares as on reporting date, whatever was the condition, based on that you have done the valuation of the shares. After 1 month, some fraud was detected, value of the shares have gone down, non-adjusting event. Is it right? Because that condition was not in existence as on the reporting date. Okay? Or for example, fall in the value of the inventory due to a new law brought in by the government. Government says no more sale of diesel car, and you have inventory of diesel cars. But this law was not even at the discussion stage at the center or the government level, but suddenly they brought a law. Non-adjusting event. So you may be tempted to answer adjusting, but you have to see whether the condition was in existence on the reporting date or not. If not, non-adjusting event. A new case was filed against the company on 1st April and you lost by 30th of June. But this case was not in existence on 31st March. Non-adjusting event. Okay. And sometimes some events may be very significant, but still they are non-adjusting. For example, you have a factory and it was destroyed in fire after the reporting date, and the company's going concern is not yet affected. Non-adjusting, but you have to disclose if it is significant. Okay. Amalgamation, merger, demerger, buyback of share, issue of share, bonus share, conversion of debenture, all these are important event, but they are non-adjusting event. Okay. So adjustments are to be made for events that provide evidence of conditions that existed at the end of the reporting period. The emphasis here is that the event provides evidence of conditions that existed at the date of SOFP, though the event itself has arisen after the date of SOFP. Is it right? Example of adjusting event. Some examples I have written, whatever maximum I could locate and find out. This list is not exhaustive. Settlement of a court case. When the entity had a present obligation as per IAS 37, then bankruptcy of a customer after the reporting period. Okay. Usually confirms that the customer was credit impaired at the end of the reporting period. Sale of inventory after the reporting period gives an indication of NRV. So again you have to see whether it will help us to find out the NRV on the reporting date or not. If it is due to some event which is purely after the reporting date, then you don't have to adjust the carrying amount of inventory on reporting date. Okay. Suppose government brings a law on 5th of April. No more sale of diesel car. Value of your inventory will fall. But this law was not in existence or even at discussion level in the parliament. Then you don't have to make adjustment to the carrying amount of NRV. Discovery of fraud or error. In case if it is proved that it is an adjusting event, you have to make adjustment to the asset or liability or income or expense. Okay. And your financial statement will get adjusted. Now we are going to solve some questions. Questions are printed at the end of the chapter. First you will read the question on the screen. Okay. So that you will get chance to think. Don't read the answer. And you have to say whether it is adjusting event or non-adjusting event. And then in the exam, wherever possible, we should write the reason. Refer the standard if you can refer it correctly. No need to refer the para number. Okay. Even in open book, no need to refer para number. If you can, there is nothing wrong also. A case is going on between ABC and company. and Tax Department on claiming the exemption for certain goods for the year 20x1 and 20x2. The court has issued the order on 15th April and rejected the claim of the company. So this matter is in process on the reporting date. Accordingly, the company is liable to pay additional tax. Shall company account for such tax in 1-2 or 2-3? What is missing in this question? Date of authorization. Date of authorization. So in all these questions, if the date of authorization is not given, we will assume that it is an event after the reporting period. Okay, so that discussion, that debate will not have. So in this question, you assume it is an event after the reporting date, and only you suggest me whether I need to adjust the financial statement of 1 and 2 or 2 and 3. Is it an adjusting event? If you adjust here, it becomes an adjusting event. If you adjust here 2, 3, it will become a non-adjusting event for this. So the answer is it is an adjusting event, and two things we need to check in every answer. How to write the answer? To decide the event is adjusting or non-adjusting, two conditions needs to be satisfied. There must be an evidence after the reporting date, and the event must have related to period ending on the reporting date. So are these two conditions satisfied? We were fighting a case with the tax department, and now the company has lost the case. So event after the reporting date only confirms a situation which is already in existence on the reporting date. Since both conditions are satisfied, court order is a concluding evidence, and the liability is related to earlier year. Therefore, the event will be considered as adjusting event, and accordingly the amount will be adjusted in the accounts. This way you have to write, otherwise student will write yes, adjusting event, full stop. Next question. All questions are printed in the notes. Company has 100 finished car on 31st March, which is having a cost of rupees 4 lakh each. On 30th April, new guidelines of pollution control are implemented, which was already expected to come, and as per the new government rules, the cars which do not satisfy the condition of using new engines which emit less carbon dioxide are totally banned for the sale. Now, it is mentioned in this question which was already expected to come. Therefore, the demand for such cars drops drastically, and the selling price came down to rupees 3 lakh. The accounts of the company for 2000 X1 X2 are not yet approved. Shall company value its stock at rupees 4 lakh or it will value at rupees 3 lakh each? 3 lakh each, because the event after the reporting date, new government rules provides you evidence of a condition which already existed on the reporting date. So on the reporting date, we were expecting a guideline will come from the government, and it has come. Since the changed of condition provide the evidence about the NRV of the cars, and therefore the amount of rupees 3 lakh should be considered for the valuation of stock. One more question. ABC Limited has purchased the new machinery during the year 2000 X1 X2. The asset was finally installed and made ready for use on 15th March. However, the company involved in installation and training has not yet submitted the final bills for the same. The supplier company sent the bills on 10th April 20x2 when the accounts were not yet approved. Shall the company include the amount of capitalization in the year 1-2 or in the year 2-3? One, two, or 2-3. Suppose you are the auditor of this company, what will you do? The asset has been installed, but the bill of installation and training came only on 10th April. So this bill only gives you more information about the cost that you have incurred in purchase and installation of that machinery. So will you capitalize this bill for this year or this year? First year. Adjusting event. Sure. As per the above provision, the cost of installation and training of the new machine was an integral part of the cost of the asset purchased. So IAS 16 will become applicable. Had you not received the bill, you would have made a provision for the same, but still you would have included that. And since now you have got the actual bill, you can write a more accurate data. Therefore, even if the details are available after reporting period, they provide proof about the circumstances that existed at the reporting date. Therefore, the cost will be capitalized for the year 1-2. You want to solve one more question? Solve. ABC Limited is in the legal suit with the excise department. Company gets a court order in its favor on 15th April, which has resulted in reducing the excise liability. So this time event after the reporting date is a favorable event. Management has not considered the effect of this transaction as the event is favorable to the company. Company's view is favorable events after the reporting date should not be considered, as it would hamper the realization concept of accounting. Comment. Should it be included? Should this information be considered in calculating your excise liability as on 31st March 20x2? Yes, even though the amount may be realized later, but we follow accrual method. So therefore the answer is yes, you can consider the effect of this event while calculating your excise liability for year ended 31st March 2002. So the answer is, as per IAS 10, even favorable event needs to be considered. What is important is whether the conditions exist as on the end of the reporting period and there is a conclusive evidence for the same. One more question. ABC Limited is trading company in laptops. On 31st March, company has 50 laptops which were purchased at $45,000 each. Company has considered the same price for calculation of closing inventory. On 15th April, advanced version of the same series of laptop is introduced in the market. Therefore, the price of the current laptop crashes to $35,000 each. Company does not want to value the stock at $35,000 as the event of reduction took place after 31st March and the reduced prices were not applicable on 31st March 2002. Very practical question. All those companies which sell laptops, mobiles and electronic gadgets will face this problem. Will you adjust it or you will not adjust it? Adjust it. Why? NRV, to estimate the NRV. Did the event after the reporting date confirm the situation which existed on the reporting date? Change in technology is a continuous phenomenon. Okay. So that risk is always there on every day. So therefore, now if we know that the value of this laptop has reduced, then instead of recording at 45,000, we will record it at 35,000. because event after the balance sheet date are taken into consideration in determination of NRV, and the change in technology can be treated as a condition which existed on the reporting date. So the answer is, as per IAS 10, the decrease in NRV of the stock after reporting period should be considered as adjusting event. One more question. JCB manufactures and sales earth moving machines. The machines are dispatched on 25th March 20x2 for export. The machine reached the customer on 15th April. The details of the price for sale, foreign exchange rate, etc. are available on 4th April. The accounts were approved by the management on 15th May. Shall company consider it as sale of 1-2 and adjust the accounts for the information received on 4th April or not? When did sale take place? Assuming that the risk and reward and control is transferred on this date, but then some details were pending. Those details like the price from the respective department, foreign exchange rate, came to the accounts department on this date. So now since they have all the information, can they record this sale for year ended 31st March 20x2, or should they postpone the revenue recognition to the next period? Can we adjust it? Yes. We will assume that all the condition required for recording the sale has been completed. As per IAS 10, if suppose the sale is subject to approval, then in that case, unless the goods are approved, but nothing is mentioned, you assume that the sale is complete on this date. Any information received after the reporting period for determining purchase of cost or sale of asset related to earlier financial year should be considered as an adjusting event. One more question. L Limited has provided for a bad debt of $50,000 towards the total amount of $90,000 received from M at the end of reporting period, that is 31st December 2019. The financial statements were authorized on 31st July 2020. In the meanwhile, M was declared insolvent and nothing could be recovered from it. Very bad. Is this an adjusting event? State the reason. Now this fellow M is already a defaulter. L Limited has provided for a bad debt of 50,000 towards the total amount of 90,000 receivable from M, which means his financial condition is already difficult, dangerous. So we already have a risk that this customer will not pay, and therefore we had made a provision for bad debt of $50,000. Event after the balance sheet indicate that this fellow has become insolvent. That means we have got only more information of a situation which existed on the reporting date. So this is an adjusting event because on 30th June it indicated that the previously recognized loss at the end of reporting period needs to be adjusted. The financial statement have not yet been authorized for issue. Okay, one more. Sham Limited is being sued for anti-competitive behavior. Very bad. This is denied by Sham Limited and only a contingent liability was shown in the financial statement. So far so good. On 14 January, the court awards $70 million as damages. The date for approval of the financial statement is 9th March. First, is it an event after the reporting date? Yes. Does it give you more information about a condition already existing on the reporting date? Yes. On the reporting date, there was a court case going on against this company Sham Limited. Decide whether the event has occurred before or after the reporting period. After, and give the accounting entry. This time one more question, accounting entry. So for this year ending date, you have to pass an accounting entry and give the disclosures also. So first question is whether it is an event after the reporting date or before the reporting date. After the reporting period but before approval of the financial statement. The event affect the valuation of company's liability because now you have to make a provision for liability, $70 million. And what journal entry you can pass? Legal cost account debit to provision for legal expenses, $70 million. So this will go to statement of profit and loss and this will go to SOFP liability side. Being creation of provision on account of court order dated 14 January. And then you have to give a disclosure like this. The company had a contingent liability of $70 million on 31st December in respect of a court case. The court order was passed on 14 January, according to which a liability of $70 million became payable. Since this happening related back to the reporting date, that is 31st December, the company provided for the liability of $70 million rather than treating it as a contingent liability in its financial statement. This way you have to write the answer. Now we will take a break. Okay. Come to question number 11 now. Question number 11. Sun Engineering was preparing its financial statement for 2008. Come to question number 11. Sun Engineering was preparing its financial statement for 2008. The company's lathe machine is under repair. So this condition is already there. There is a lathe machine which is under repair. When will a machine go for repair? When there is some problem with this machine. Its carrying value in the book is $1,75,000. While the financial statements are under preparation on 27 January 20x9, the company is informed that the machine is irreparable. Machine has become irreparable and the scrap value is $25,000, which means this machine has been impaired now. So you have to make a provision for impairment loss. Event after the reporting date only confirms that the machine has become impaired. Discuss how this would be dealt within the books. Okay. So is it an adjusting event? Will you make a provision for impairment loss? Yes. How much impairment loss provision you are going to make? Its book value is 1,75,000 and its now recoverable value is 25,000. So 1,50,000 is the loss in the value of the asset and that you need to provide for. So you will write the answer. The financial statements are not yet approved. Also, it is an event after the reporting date and it affects the valuation of the asset at the end of the reporting period. Hence, it is an adjusting event. Therefore, Sun Engineering would have to reduce the carrying amount of the machine to $25,000. Following accounting entry needs to be recorded. Impairment loss on lathe machine account debit $1,50,000 to lathe machine account $1,50,000. Being impairment loss on lathe machine recognized. Question. Not on this. Then if A has given guarantee on behalf of B and B defaulted after the reporting period before approval, A has given guarantee on behalf of B, but B's condition on reporting date is good. After the reporting date, B's condition have become bad, and you may be called upon to pay the guaranteed amount. Contract of guarantee is there, but before the financial statements were approved, B has become insolvent. Is it right? And then you will be called upon to pay the guaranteed amount. So that means, as on the reporting date, we have to see whether the event after the balance sheet date conforms to a situation on the reporting date. If on reporting date there is no problem, because this is contract is there. No, when you have a customer also, this question is tricky. If suppose instead of B there is a customer, and the customer happens to be a very good customer, after the reporting date if he becomes insolvent, then the question will arise, first customer, okay, then in that case there are answers given by the institute and in the IFRS notes also. No provision is required, because as on the reporting date the customer happened to be the good customer. Same thing can be answered here also in this context. If on the reporting date there is a guarantee, then only disclosure as a contingent liability will be required. Similarly, in the case of guarantee, you do not presume that you will be called upon to pay the guaranteed amount. With the customer also the contract is the same. In case of guarantee, you don't assume that the other party is not going to pay. Bank gives guarantee every day to lakhs of its customer. Is it on the assumption that they will not pay, or is it just to be on a security wise point of view? Okay. Non-adjusting event. But to be on a safer side, what you can do, this is my suggestion, in all such cases, once you have known that the parties has become insolvent before the financial statements are approved, and you know that you are not going to receive, it is better to make a provision for that. So in the exam for such question, you should say that on the reporting date what is the condition, good, no problem. Then subsequently if it turns out to be bad, no adjustment is required. However, on the concept of prudence, you can say, once we have known that this fellow has become insolvent, we should create a provision for the same. Non-adjusting event. After solving so many questions on adjusting event, now we will see non-adjusting event. When the events are those that are indicative of conditions that arose after the reporting period. Indicative of condition that arose after the reporting period means these conditions originated after the reporting period. These do not relate to condition on the reporting period date. Then this will be called as a non-adjusting event. An entity should not, what is the treatment? Entity should not adjust the amount recognized in the financial statement to reflect the non-adjusting event after the reporting period. Examples of non-adjusting event. There is a long list of examples. Decline in the market value of investment after the reporting period, but before the financial statements were authorized for issue, is non-adjusting event, because for the purpose of valuation of investment we have to see what is the value on the reporting date. Business combination after the reporting date. Disposal of asset, disposal of subsidiary, associate or joint ventures. Then announcing a plan to discontinue an operation or classification of asset as held for sale under IFRS 5. What is IFRS 5? Non-current asset held for sale and discontinued operation, purchase of major assets. These are all non-adjusting event. Expropriation of major assets by the government. Destruction of a major production plant or asset by a fire after the reporting period. announcing or commencing the implementation of major restructuring. Major transaction in ordinary share. Whatever may be the transaction in share, like bonus share, right share, buyback, share split, fresh issue, potential share transactions like stock option, non-adjusting event. Abnormally large changes in the asset price or exchange rate, non-adjusting event. Change in tax rate and that affect deferred tax asset and liabilities significantly, non-adjusting event. Major litigation arising from events occurring after the reporting period. Litigation which were in progress on reporting date and some more information you got after the reporting date is an adjusting event. But litigation which arises after the reporting period, non-adjusting event. Now what is the treatment for non-adjusting event? Non-adjusting events, if they are significant, are required to be disclosed in the notes. Where are they required to be disclosed as per this standard? They are required to be disclosed in the notes. Some question answer session will begin. But before that, we have made a small summary on the next page. Can you see that? A small summary, a diagram at the top. Event occurring after the reporting date, adjusting, non-adjusting. Events that provide evidence of conditions that existed at the end of the reporting period. Event those indicative of conditions that arose after the reporting period. Warrants adjustments to SOPL and SOFP. Does not warrant adjustment to SOPL and SOFP. No disclosures are required. Disclosures are required. So this is a small quick summary of adjusting and non-adjusting event. Now some question answer will begin. Exchange rate plummeted on 2nd October 20x7. What is plummeted? Increase or decrease? PLUMMETED. Fallen. Gone down. Is it right? Exchange rate has gone down on 2nd October. As a result, the market value of an investment held by Venus Limited decreased by, market value of investment they are talking, decreased by $3 million and continued at the same level until the date of approval of the financial statement on 12th December. The value of the investment on 30th September, that is your reporting date, is $5 million. And due to exchange rate decline, it has gone down by 3 million. How will this be dealt within the financial statement of Venus Limited on 30th September 2007? Give the necessary disclosures to be made in the financial statement. Adjusting or non-adjusting? Non-adjusting. The standard specifically gives you this example, that major changes in exchange rate will not be an adjusting event. Investments will be valued as per the value on the reporting date. Okay. So it's a non-adjusting event. However, you need to give the information to the investor that, dear investor, due to change in exchange rate, the value of the investment have gone down. So ultimately we are informing him in one or the other way. If not in the SOFP, then in the form of notes. So that is also enough for a person to take the decision. The event does not affect the value of the company's asset or liability on the date of statement of financial position. However, this is a significant event. Why significant? $5 million decreased by $3 million, 60% decline. Is it not significant? Which will influence the financial position of the company in future. Hence, a disclosure regarding the post statement of financial position decline in the value of statement is to be made in the financial statement. Where it is disclosed? In the notes. So what is the disclosure you have to write? If they ask you to write a disclosure, you will write like this: the stock value of stock held in Venus Limited is $5 million at the end of the reporting date. However, due to a crash in the foreign currency market and the stock exchange during October 2007, value declined to $3 million and continued at the same level until the date of approval of financial statement of the company on 12 December 2007. Okay, only one small correction is required. It is 2. You make it by, because the question here says market value of investment decreased by $3 million. Okay. Next summary we have discussed. This also we have actually discussed: date on which financial statements are authorized for issue. If board of directors is the agency to authorize the issue, then the date it is authorized by the board. But if there is any other supervisory body, then the date when management has authorized to be issued to the supervisory body will be the date of authorization for issue. Sometime the company may declare profit or other financial information, that we have discussed also. That will not be considered as the date of authorization, even though that date may happen before the date of authorization of financial statement by the board. To understand this last paragraph, we'll solve one question: the date of declaration of profit or other financial information to the public may be earlier than the date the financial statements are authorized for issue. So on this point, there is a question number 6. ABC Limited has announced its interim result. This problem sometimes can arise if it is a listed company for Q1 ending 30th June on 5th July. However, till that time the AGM for year 1-2 was not held. The account of 1-2 were approved by the board on 15 July. Question number 5 actually. Okay. Accounts were authorized for issue by board of directors on 15 July. What will be the period after the reporting date as per the definition of IAS 10? Now here the student can have two answers. One can say up to 5th July. One can say up to 15th July. Which is the right answer? The date when the results of interim period was declared, or the date when the accounts were authorized for issue by the directors? Which date you will write in the exam? 15 July. As per IAS 10, even if partial information is published, till the reporting period will be considered as the period between the date of reporting period and the date of approval of accounts. In the above case, accounts were approved by the board on 15 July. Therefore, the reporting period up to 15 July will be treated as event after the reporting period. Okay. Tick dividend. What about dividend? Dividend declared to equity holders after the end of the reporting period are not considered as liability, because as on the reporting date there was no approval, and therefore it is not recorded as adjusting event, because there is no present obligation as per IAS 37, but you have to make a disclosure in the notes. This standard also says, IAS 1 also says, that dividend proposed or declared after the reporting period is a non-adjusting event. A disclosure in the note will be required. Now there will be few questions on dividend. Question number 4. ABC company declares the dividend on 15 July 20x2. As the results of year 20x1 and 20x2 as well as Q1 ending on 30th June 20x2 are better than expected. The accounts of the company are approved on 20th July for the year ended 31st March 20x2. State whether the dividend will be accounted in financial year 2-3 or it will be considered as a proposed dividend and accounted for in the year 1-2. 2-3. For 1-2 only a disclosure in the notes will be required. So as per the interpretation of the provisions of IAS 10, dividend is declared in year 2002-3. Event did not exist on the end of the reporting period. So there was no liability on 31st March 20x2 and therefore it will be accounted in the year in which it is approved by the AGM. Then the liability arises and not in 2001-2, even though the accounts of 2001-2 were approved after the declaration of dividend. So this is a specific adjustment given in the standard about dividend. One more question. Question number 12. Sona Lights has prepared its financial statement for the period to 31st December 20x9 on 20th January 20y0. That means we'll take 19 and 20. Okay. Before the authorization of financial statement, directors declare dividend totaling $2 million. Explain whether this is an adjusting or a non-adjusting event and mention the effect of this event in the financial statement. So this is very easy. As per IAS 10, proposed dividend are not recorded in the books by way of a liability because no obligation exists as on 31st March or 31st December 2009 in this example. Hence it is a non-adjusting event. Financial statement do not warrant any adjustment entry. However, the notes to financial statement should disclose the amount of proposed dividend in the notes on retained earning. Is it right? Now one more important paragraph tick mark, that is called going concern. Going concern. Going concern means the entity is going to continue its activity for a foreseeable future, that is at least for 1 year. But if there is any event after the reporting period which suggests that the entity is not a going concern, then it is not just an adjusting event. The whole accounting base will change. Hello? The whole accounting base will change. It is not just a normal adjusting event. The basis of accounting itself will change because you are not going to prepare your financial statement on a going concern basis. So every item of assets and liabilities base of accounting will not be on the going concern basis. So normally if you follow cost method of accounting, cost model, now you will not follow cost model. Now you will see what is the realizable value of this asset, what is the redemption value of these liabilities, and on that basis you are going to prepare your financial statement. So therefore it is considered as a separate heading in this standard. The entity is not allowed to prepare the financial statement on a going concern basis if the entity intends to liquidate the entity or cease trading, or it has no realistic alternative but to do so after the reporting period but before the financial statements are authorized for issue. So then you can't prepare the financial statement on a going concern assumption. In such cases, underline, there is a need to be a fundamental change in the basis of accounting. So it is not just a normal adjusting event. It will require a fundamental change in the basis of accounting. So is it an adjusting event or a non-adjusting event? It is much more than an adjusting event. So therefore the standard says it is not just an adjusting event. It will require a fundamental change in the basis of accounting rather than just treating it as a normal adjusting event. or a disclosure event. Additional disclosures about the basis of preparation of financial statement. So you have to disclose what is the basis of preparing your financial statement. It may be based on realizable value. Okay, it may be based on redemption value of liability. And the management estimate of the uncertainties are to be made in accordance with IAS 1. Is it right? Now we'll come to the disclosure aspect of the standard. What are the disclosure requirement? In the notes to account, date of approval of issue you have to disclose, so that the users can understand on which date the financial statements were authorized for issue. Then identification of the appropriate level of management which gave the authorization, whether it is board of directors or any other such level of management. The fact that the financial statement can be altered either by the owners or others after the issuance, this you have to disclose, that even though financial statement have been authorized for issue, it may be changed by the owners or others after the issuance. This power has been given in certain jurisdiction, certain laws. Okay, for example, in the Companies Act 2013, section 130 and 131 allows the revision of financial statement. Underline and you have to write this example. So in case if the law of the country provides that even after the financial statements are authorized for issue, it can be altered by the owner, then you may have to disclose that in the notes to account, like section 131 and 130 of Companies Act 2013. What about the disclosure requirement for non-adjusting event? Disclosure requirement for non-adjusting events. First understand, where non-adjusting events are material, underline material. Otherwise every day there are lakhs of transactions which takes place. If I purchase tea for the management staff, that is also event after the reporting date only. Is it required to be disclosed? No, it's not a material. So non-adjusting event has to be material. Material what we have defined in IAS 1. And the non-disclosure of which could influence the economic decision of the user. Once you ensure that these two conditions are satisfied, this is material. If you don't disclose, it might influence the decision of the user. Then following disclosures will be required. One, nature of the event. So you will say our company has acquired a subsidiary. Okay, there is a fire in one of the factories of the company and the loss was $20 million. And wherever possible, an estimate of financial impact will be given. Wherever possible, you will say that there is a loss in one of the factories and we have lost inventory of $20 million. What if you can't give the effect? That fact should be disclosed. Where should disclosures be made about non-adjusting event? As per this standard, it will be disclosed in the notes. Okay, the disclosures already made in the notes to account shall be updated on receipt of information about the condition that existed at the end of the reporting period. And then you have to keep on updating the disclosure. Keep on updating the disclosures. The disclosure already made, this line I have read, in the notes to account shall be updated on receipt of information about the condition that existed at the end of the reporting period. One example of the need to update the disclosure is when evidence becomes available after the reporting period about a contingent liability that existed at the end of the reporting period. So there may be a contingent liability at the end of the reporting period and it might have become an actual liability. then you have to update the disclosure. In addition to considering whether it should recognize or change a provision under IAS 37, an entity updates its disclosure about the contingent liability in the light of that evidence. So you will say this item was disclosed as a contingent liability. Now it has become an actual liability and therefore a provision has been made with respect to this. So this is called updating the disclosures. This completes this wonderful standard IAS 10. Now there is one important difference between IAS 10 and Ind AS 10, which is called carve out, and this is given in IAS 1 also. What is that? Suppose a company has taken a loan and on the reporting date there was a breach. Breach means default in terms and conditions, and therefore the loan became payable on demand. Okay, because the loan has become payable on demand, it becomes a current liability. But before the financial statements are authorized for issue, the company renegotiates with the bank. Bank agrees to waive the breach and allows you to continue with your loan liability as usual. But in IFRS, means the number is IAS 10, it will be a non-adjusting event. The liability will now appear as a current liability even though the breach has been rectified. But in Ind AS 10, if there is a breach but has been rectified before the financial statements are approved, it will become an adjusting event and you will continue to disclose it as a non-current liability. Okay, this is there in IAS 1 also. This is a major difference because it changes the position of the liability in your financial statement. Your current ratio figure will change significantly because of this. Is it right? In which statement? IFRS or Ind AS 10? In IFRS, next year it will become current. Next year it will become non-current. Yes, again you have to change. Now I want to see whether you are learning or not. MCQ. 8 MCQ we will take. Okay. First MCQ. IAS 10 identifies the period covered by the event as starting immediately after the reporting period and ending on the date of, three options are there. Ending on the date of issue of financial statement, approval of the financial statement for issue, or publication of the financial statement. Approval, date when financial statements are approved for issue. Okay, the answer is B. One more chance. On 29 January 20x9, management of a company completes draft financial statement for the year ended 31st December 20x8. On 4th February, the board of directors reviews the financial statement and approves them for announcement on 19th March. Approves them and it was announced on 19th March. 15th February, the company announced its profit. Other selected financial information is announced on 19th March. On 18th March, the financial statements are made available to shareholders and others. On 25th April, the shareholders approve the financial statement. On 29th April, financial statements are filed with regulatory body. So as I have told you, this kind of question you have to face. Which date will be treated as the date when financial statements were authorized for issue, or what will be the period covered by IAS 10 in this example? So option number A. Which period you will cover? Up to which date? A, B, C, D, E, F. 4th February will be the cutoff date. Okay. Which of the above date marks the end of the period covered by IAS 10? So your answer will be 4th of February. Is the answer B? Yes. Okay, try one more. There is a settlement after the reporting period of a court case that confirmed that the company had a present obligation at the end of the reporting period. That confirmed that the company had a present obligation at the end of the reporting period. You need to adjust, leave the financial statement but note the details and ignore it. What is the answer? Is it an adjusting event? Yes, answer is A. Okay, try one more. You learn of the bankruptcy of a customer that occurs after the reporting period. You need to adjust the financial statement, leave the financial statement but note the details, ignore it. So bankruptcy of a customer, what is the more appropriate answer? Before the financial statements are authorized for issue, you know that the customer has become bankrupt. So it is better to adjust the financial statement. Is it right? A. You learn of a change to the proceeds from assets sold, underline before the reporting period. Before the reporting period, if you get to know, question is it an adjusting event? Non-adjusting event? Ignore it. Anything happened before the end of the reporting period is an adjusting event. So this is actually question not related to this topic only, but they wanted to see whether the student is reading carefully or not. So before the reporting period, if any event transaction takes place, it has to be recorded. Okay, one more. You learn of a decline in market value of investment between the reporting period and the date when the financial statements are authorized for issue. You need to adjust the financial statement, leave the financial statement but disclose in the notes, ignore. So this is specifically mentioned in the standard also. A decline in the market value of the investment after the reporting period and before it is authorized for issue is a non-adjusting event. So the answer is B. Okay, try this one. You announce plans to reorganize your group between the reporting period and the date when the financial statements are approved for issue. The plans include the disposal at a major division. You need to adjust, leave the financial statement, disclose in notes, ignore. So any such reorganization after the reporting date is a non-adjusting event, but because it's significant, disclosure in the notes is required. Okay, one last chance to you. 5% of your assets are held in euro. 5% only. Out of 100, 5% is in euro. Your currency loss is 1% of its value. So 1% of 5% is the loss in euro before the financial statements are approved. Is it right? You need to adjust the financial statement. So after the year ending, before the financial statements are approved, you find that there is a change in the rate of euro, and those assets which are held in euro, you have lost 1%. So really speaking, it is what percentage of your total asset? 1% of 5%, okay, of your total asset. Now whether it is material or not is a subjective issue, but there is a note number C which says ignore it as it does not have a material effect on the financial statement. The value of the asset for which there is a euro loss is only 5% of the total asset, and the euro currency loss is just 1% of the asset facing the currency loss. So what is the answer? Ignore it or disclose in the notes? In this example, the answer is ignore, because it is not a material amount. It is just 1% of 5% of your total asset. Okay. So the answer is C this time. This standard is over. Remaining questions are homework.